Every earnings season, dozens of stocks jump 5, 10, sometimes even 20% in a single day. But here's the uncomfortable truth. Most of those stocks go absolutely nowhere after that. So the real question is, how do you find the earnings stocks that actually keep moving? In this video, I'll show you a simple but powerful ChartMill screen designed specifically to spot post-earnings momentum stocks. Stocks that didn't just react to earnings, but showed real follow-through in the days after. And there's one filter in this screen that quietly eliminates most false earnings moves. Yet it's the one traders most often overlook. Just to be very clear up front, this screen does not give you buy signals. It's a starting point, a way to quickly build a high-quality watch list that still requires analysis, planning, and risk management. If that's what you're looking for, let's break this screen down. Before we even look at earnings, we start with a few basic quality filters. First, price above $5. That removes penny stocks and low-quality noise. Second, average daily volume above 300,000 shares. Liquidity matters, especially for momentum trades. And finally, at least small-cap stocks. We're avoiding micro-caps that can't sustain real follow-through. Now we get to the catalyst. This screen only includes stocks that reported earnings within the last 2 weeks. And that time window is more important than most traders realize, especially for swing trades. I'll explain why in a moment. Next, we require at least plus 8% performance over the last week. This immediately filters out weak or indecisive reactions. If institutions are interested, price doesn't drift sideways. It moves. Now we check if momentum is actually holding. We want EMA9 rising, EMA21 rising, and EMA9 above EMA21, because most earnings failures already show weakness here before price breaks down. Next, we require a relative strength score above 80. Post-earnings momentum works best in leaders, not laggards. This ensures we're focusing on stocks outperforming the market, not just reacting temporarily. Here's why this screen is so effective. It combines 4 powerful forces: a fresh earnings catalyst, strong price confirmation, trend alignment, and market leadership. Now comes the most important part. Once you have this list, don't buy anything yet. Instead, look for tight consolidations after earnings, pullbacks into rising EMAs, clear invalidation levels. Some stocks will be extended, some will fail. That's normal. That's why the 2-week earnings window matters. Institutions don't build positions in one day. So to recap, this screen helps you find post-earnings momentum candidates, not trade signals. Let me show you a real example of how this screen can surface high-quality post-earnings momentum and how patience makes all the difference. This is Marriott International. Marriott reported earnings here, and within the next 7 trading days, the stock was up more than 11%. That already satisfies our performance filter. Strong, decisive post-earnings momentum. Now here's the part most traders struggle with. After this initial surge, price doesn't just go straight up. Instead, it pulls back. In this case, price pulled back neatly into the EMA9, and notice what didn't happen. EMA9 and EMA21 both stayed rising, and EMA9 remained above EMA21. This is where a lot of traders get shaken out. They see a pullback and assume the move is over. But this is exactly why we included the EMA filters in the screen. After respecting the EMA9, the stock turns higher again. And that's the kind of continuation behavior we're looking for with post-earnings momentum. Not chasing the breakout, but waiting for structure. This is exactly how this screen is meant to be used. It finds candidates with potential. Your job is to wait for confirmation, structure, and controlled risk. Now let me show you a very different but equally important example. This is a trade that made sense, but still didn't work. This is AMETEK after earnings. We see a strong initial post-earnings surge, exactly what we want. Price then pulls back into the EMA9, while EMA9 remains above EMA21. And right at that level, we get a bullish reversal candle. From a trading perspective, this is a valid long setup. The trade is well defined. A logical stop would be just below the low of that reversal candle. So before entering, you already know exactly how much you're risking. Unfortunately, this time, the trade doesn't follow through. Price fails to continue higher, momentum stalls, and the stop is hit. That's not a mistake. That's just trading. This is what a good trade with a bad outcome looks like. The setup was valid, the risk was controlled, and the loss was small. That's exactly how momentum trading is supposed to work. Same screen, same logic. One winner, one loser, same process. Thanks for watching. See you in the next ChartMill video.